But no, stocks falling through the floor, Bitcoin falling through the floor, Ethereum at a pretty great buy price if you ask me at this point. So you might want to build that bag up, you feel me? But anyway, everyone and their mom talking about a recession. And you've probably seen 100 videos in the past week on the SOM rule. Well, today, we're going to touch on all of that. We're going to give our opinion on if we believe that we're in a recession based on the data or not, and what our plan is moving forward. So guys, without further ado, let's get into it.
All right, guys, starting with the central bank balance sheet. I know we haven't done one of these macro calls in a while, but we're back, and this seems to be falling back down. So we're back near pre-COVID levels. We were here in May of 2020, and everything started to get crazy around February.
But let's be clear, though. Even right before COVID, the balance sheet was still a bit too hefty. I would say in order to be healthy for the Fed, what's normal for them is having about 4 to 4.5 trillion worth of assets on their balance sheet. But because, they've been buying more bonds over the past 4 years, you're going to see a more buoyant balance sheet in terms of the amount of assets that they hold. And so we're still very, very high at this point. And so by lowering the balance sheet, that basically exacerbates QE a bit more, at least interest rate QE in terms of, them lowering interest rates. This is like QE in the background. So it exacerbate or help the muted effects that they've had over the past year, thanks to us being in a more fiscally dominant era, by offloading their balance sheet at such a slow pace like they're doing. Like I said, it's QE in the background, and it kind of helps amplify the interest rate moves or potential interest rate moves that the Federal Reserve will carry out.
Yep, moving right along. The M2 money supply is just still kind of consolidating. Not many changes there. You got gold still hovering around all-time high levels. And now to the bloodshed. We have the S&P below our 62 EMA, which is our rolling Fibonacci. Now, this past drop wiped out $2.1 trillion from the stock market. Now, that is no small feat. We're going to get into, recession fears and our thoughts on that as well here pretty soon. But just want to go through these. You have the Dow Jones, 2 big red wicks. The NASDAQ, same thing. We're not at our 200-day yet, so I'm not like super worried. Like, it could be a narrative that they're pushing. And as you can see, like, anytime we have these huge rips up, we always have like a steep drop down, albeit this one is a lot steeper than we've seen in I don't know how long. But we are in an election year and things are getting kind of crazy. We still have Apple near all-time high levels, but it did go and have a big drop in the past month. And if we start looking at crypto, we have Bitcoin below 60K. So look at these red candles. We are at 53 right now.
60K was a very, very key level. So
very key. And Ethereum, we just had Ethereum ETF. The Bitcoin ETF was the most successful ETF launch in history. Ethereum was the second most successful spot ETF launch in history. And if you guys didn't know, there's around 6 ETFs that launch globally every single day, and around 3 in the US, if I remember correctly. So that's no small feat. And for it to be doing this when we have like institutional adoption, it says a lot. Now, I personally think that the powers that be, whatever you want to call them, they're trying to get the prices low so they can fill their bags up. The one thing you have to keep in mind with institutional adoption is that it is also going to be easier to be manipulated because you have players who couldn't step in. They can now step in and manipulate it since it's such a small market. Like the ETH market cap is only 278 billion, while Bitcoin is just a hair over $1 trillion at this point.
A couple million hairs, but yeah, a hair nonetheless.
Yeah, a couple million hairs. And if we look at the total crypto market cap, we're below our 200-day, we're below our 62. And if I go and look at the weekly, I'm not really tripping off of this, guys. And the reason why is because this 62 EMA acts as like the mean. Things always return to the mean. And if you look at these 2 big pumps, it always came back down and touched it, or almost touched it. You did it here, came back down here, and then even on coming upwards. So it was only a matter of time before we got back here. These charts, when you're looking at them, it's everyone's fear and greed. So in order for us to have like all-time highs and explosive rally, I think this kind of thing needs to happen. This is the altcoin season index. When the chart is up here above this line, these were the times where we had our explosive altcoin rallies, right? And as you can see, we've been under it. And now we're super under this blue line. So this tells me this is a good price point to start buying altcoins as we prepare to start jumping up into these higher levels.
I would agree. So I actually think a lot of the stock market collapse that we've seen lately, not 100% of course, but it has a lot to do with the margin calls that we've experienced due to the expiring the Japanese yen carry trade. So the carry trade is effectively borrowing in a currency that has a low interest rate and then reinvesting into a currency with a higher interest rate. And so in the case of the yen versus the US dollar, it's borrowing in yen and then investing in US stocks essentially. Now, what has happened is because the Japanese yen has been pretty much on a steady decline since 1995, pretty much, the carry trade has worked pretty well for investors in the past. And as you can see at this latest uptick starting in June, the yen has been gaining strength versus the dollar. So imagine you have, let's say, $100 and you borrow $100 in Japanese yen, $100 worth, and then you buy $100 worth of US stock, and then you lever up effectively. So let's say you levered up, let's just say 10%. And so now you have $110 total invested into US stocks. Now, ideally, if you're trying to do a carry trade on the Japanese yen, when you pay that money back in yen, it's going to be cheaper. And so you technically profit by carrying out that strategy. What this does, it goes in reverse. And so now it takes that leverage and now you have less equity in the deal and you're pretty much all levered up because the Japanese yen is moving to the upside, which means those margin calls are automatically triggered. And that has happened a lot in the US stock market over the past, I don't know how long, but it's been happening for a long time. And so you're seeing a lot of that happening right now. And of course, that's going to affect US stocks to the downside because a lot of people they're basically being forced to capitulate when they don't really want to. So I think a lot of the downside we've seen in the stock market has a lot to do with that trade because it's been pretty popular. I'm sure you guys have heard it over the past year. I feel like a lot of people have been talking about it. That's just one thing that's affecting the stock market to the downside. Other than that, I can't really see why the stock market has been collapsing like it is. And of course, because you're dealing with risk assets, I think Bitcoin is just kind of following suit, to be honest. There could be a lot of leverage still, obviously, in the Bitcoin network, but I think it's just more following suit in terms of risk assets at the moment. So I don't think if you're just looking at the stock market, I wouldn't look at this and say, oh, we're definitely in a recession, because there are other things that are behind the scenes at play. But with this being kind of the catalyst for the stock market moving to the downside, I could see us, moving down that path further, and that we probably are going to hit a recession like in the very, 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 very short term, if we're not already in one. But if I was just looking at charts, and knowing what's going on in the background, I would say that we're not in a recession, only if I was looking at charts. It's kind of a really big thing, guys, because all the attention that's been put on the carry trade, even just over the past year, you get a sense of how much leverage actually exists because people have been banking on the Japanese yen being deflationary, moving forward. And no one expected the Japanese yen to move to the upside like it is. So that basically just rendered all those investments poor investments. Now, moving on to the US. Now, at the last meeting, the Federal Reserve last week decided to hold rates steady. And a lot of people actually thought that they should have cut rates in July, citing the inflation numbers, because the latest PCE report, which is the Fed's preferred inflation gauge, came out. I'm talking about core. It came out at 2.5%. And so you could say we're definitely closer to your goal. And because monetary policy acts with a lag, they could end up in a position to where they have to either cut too rapidly because inflation is killed and it's lower than they actually think, which we would see in these next few reports coming out. And so a lot of people are saying that they basically waited too late and they're essentially fucked. Now, I'm also in the camp that they should have cut in July. I was saying they should cut in July since I don't know how long, but it became obvious that they weren't going to cut in July. And so I ended up making a video on that and how it's basically rate cuts got pushed, right? And one thing that they were monitoring pretty heavily, and you probably heard different channels speaking on this, I don't know, a lot of videos, but the SOM rule. The SOM rule states that the national unemployment rate, the 3-month average of that national unemployment rate, if it moves up 0.5%, so 0.5% over a 12-month span, that indicates that we are currently in a recession. Now, that SOM rule has been triggered. And now, as you can see here, we're at 0.53%. The last time we discussed this was back in March, and we were at 0.2% for the February read. And so now you could say the SOM rule is definitely triggered. So does that mean we're in a recession, or is that rule broken now? Well, if you look at all the other data, right? Let's go to the jobs market really quick. So in this latest jobs report, we've added 114,000 non-farm payroll jobs. Now, if you look at the previous number before that, that number was 206,000 jobs. So that's almost 100,000 jobs that we didn't add for the month of July. And June report actually got revised down to 176,000 jobs. And so one could say, damn, the labor market has been a lot cooler than we thought over the past year, like a lot cooler, if you account for all the revisions. Some would say 60 to 70% of the data that we have, it's like fluff. It's like not actually there. It's like fake data, essentially. So the labor market has been extremely soft. I think softer than the Fed would like as well. And that was one of the biggest risks that they faced, because if they could have avoided a recession and achieved a soft landing, it would be because they found a way to put a floor under the labor market and to mitigate the amount of softening that we do experience. But, 2 days after they decide to hold rates steady, we see a tick up in the unemployment rate, which triggered the SOM rule. So if you're only looking at that, yes, we're definitely entering a recession at some point. But the consumer data, accurate or not, consumer data is still looking pretty good as well. So if you're looking at consumer spending, if you're looking at wages, if you're looking at all these other data points, I mean, it's kind of balanced out at this point. And if you look at the inflation numbers, as we just mentioned, if you monitor true-flation, that was at 1.53% the last time I checked a couple days ago. And so they definitely have gotten the reins in on inflation. If I were to give a conclusive statement on if they beat inflation or not, I would say that they have beat inflation at this point. So they've accomplished one side of the mandate. The other side is maximum employment. And now, since the unemployment rate is going up, obviously you can't really say you've maximized employment because we got the unemployment rate ticking up. Now, in the history of the US, and we mentioned this before, there's never been a recession under 5.4%. But this could be one of those cases where either we'll have a huge spike in unemployment, or we will get this recession with the unemployment rate for the first time ever in history under 5.4%. Now, if I have that train of thought in which I just laid out, okay, guys, we're definitely about to experience, if we're not already in one, we're definitely about to experience a recession, right? On the flip side, this could just be one data point. And the Fed, at this last meeting, he kind of said something new. He said that we're data dependent, but we're not data point dependent. That was my first time hearing him say that. And I thought that was very important to kind of ease the mind of the market as well. Whether it worked, I'm not sure. But I still think it was an important statement to make and say we're data dependent, we're not data point dependent. And so this could just be one data point that it's just a softer print. It could just be that. And then the next print could be like the unemployment rate could either stay the same, it could drop even lower, or we could just add more jobs on the next non-farm payroll report. And so this could just be one piece of data and it just freaking us all the fuck out because we've been waiting on this data and it's kind of giving us confirmation bias in that way. And so we shall see. I am in the camp that we are having a recession, by the way. If we're not in it, as I said like 3 times already, we're definitely about to experience a recession. And also because we're in a period in which fiscal dominance is like the regime that we're in at the moment. I think that monetary policy will continue to have somewhat muted effects. It's not going to be as blunt as it normally is because we have so much spending by the government kind of counteracting what the Fed is doing. And so at some level, I don't think we're going to get back down to 2% inflation on the Fed's preferred reports. If we do, I would genuinely be surprised. If I see even a 2.1% handle, I'll be surprised. I think we've in a way bottomed out in inflation at this point. I can't really see it moving lower. And so I can only see inflation moving higher, which means they will still have to battle that inflation. And so by going into rate cuts or going into an easing cycle by lowering rates versus just letting the balance sheet dwindle off or run off, is the appropriate term, you could risk igniting that inflation even more, and you'll be in a predicament. If you're the central bank of the US, you'll be in a predicament in which you've been trying to avoid for God knows how long at this point, which eventually that will lead us back to a recession anyway. And so either way, we're fucked. Like, no.
Man, you think they gonna let us go into a recession right before elections? Well, I'm not gonna say let us, because it's not like it's 100% under their control, but like.
Well, at this point, I don't think they can stop a recession. You got too many things that are pressing downward on the economy at this point. You really do. I don't think they can stop it. They've done a pretty good job at kind of giving that soft landing aesthetic, right? I remember back in the day, we were even over here talking about, damn, did they achieve the soft landing? So I don't think they can stop a recession either way. And, they want to remain apolitical. But I think that a lot of people are expecting a cut in September, right? Even if we got a cut in September, I still think we're going into a recession. So at this point, they just got to act. You either act or don't act. The next meeting after that is in November, like a couple days after election. And so that would be like, if we were to let the shit go and just be like, all right, just let the lever go type deal, it would be right after the recession. So if Donald Trump wins, he would come into office dealing with a recessionary economy. And if the Democrats win, they would probably turn into a depression, I'm gonna be honest. But
I was gonna say they probably fuck everything up.
Yeah, because that's where most of the government spending is going to come from. Don't get me wrong; both sides spend like crazy. They do, but Democratic policies have been known to cause a ton of inflation, and I don't think they would stop. I haven't heard anyone talk about UBI in a long time, but I feel like it's buried in the paperwork somewhere in there. I wouldn't be surprised if there's a reignition in that conversation coming down the pipeline, which will be super inflationary for the economy. So it's not that they would let the economy slip into a recession before election. I just don't think they have control over it. You have two forces battling against each other in terms of fiscal and monetary policy when they're supposed to work together. And I think at this point you can't stop it. Now with the carry trade and the effects that it's having on the stock market with the margin calls, and then you have monetary policy finally affecting the labor market how we thought it should initially, right? You got too many things pressing downward. And even if they were to move or cut now, the effects from having interest rates elevated for so long at such a high level relative to the zero bound, because we were at the zero bound. So we're up, 500% on interest rates. So yeah, I just think there's not much they can do at this moment because of those things. And this is all while GDP, by the way. Atlanta Fed's GDP now, it's showing a projection of 2.5% on the next GDP print for next quarter. And so, obviously a technical recession is 2 consecutive quarters of negative GDP, but something is going to be different this time. I don't know what is going to be different this time, but it's going to be based around it's being different, but we're still having a recession. And so, yeah, interesting times we're in, man. What are your thoughts on it, bro?
All I see is discounts, man. This is why we always stress keeping some capital on the sidelines, because investing is that one store. Once everything goes on sale, people run out of the damn store instead of getting happy.
I think the question these people want to know, right?
You don't know these motherfuckers. So no.
Hey, I know these motherfuckers, right? Hey, I know y'all, right? Come on. No, but so I think what they really want to know is, how steep of a discount would you expect? Let's say, what would you expect? How much greater would this discount become over the next couple of months?
Well, just rewinding a bit, if we look at previous cycles, and I know we always say this time's different, but this time really is. It really is. Every other Bitcoin halving / crypto bull cycle was paralleled with low interest rates. This is the first time where we're going into a bull market when they're high, but this is also the highest institutional adoption that we've had also. Very, very interesting election as well. So
very interesting election.
Very, very, very. So in terms of like how low do I think it can go? I mean, me and Float Locker, shout out to Float Locker, we were talking about a 50K Bitcoin like last month. I wouldn't be surprised if we got down to 45. And as far as ETH goes, ETH is interesting because a huge majority of ETH is locked in the beacon chain that can't be unlocked. You have a lot of ETH in DeFi, people using for leverage loans and stuff like that. So I'm actually surprised ETH is at 23, but I wouldn't be surprised if we saw it go down to like maybe 17. But what I would say is have your worst case scenario in mind and then plan on it going maybe another few points below that so that if it does, you still have some dry powder. Because what happens is when we see things going up, we'll go in pretty hard, but we don't do the same thing when it goes down. And we always wish we had. So I wouldn't be surprised if we saw a 40K Bitcoin. I wouldn't be surprised if we saw a $1,500 ETH. I would be surprised actually, but I would be happy. But what I do know is that fundamentally everything's going good. Like I said, we just had the ETH ETF get launched. So we need to have some time to let, people get comfortable with that, the market kind of warm up to it. And I think that, then this is the point that I was going to say at first. Going back to previous cycles, Bitcoin dominance normally drops 200 days after the halving. And that's when we see an altcoin rally. That puts us at November, right at the election. Now, I don't know who's going to win. I know who I hope is going to win. I'm not going to say it here, but I'm expecting to have some fireworks toward the end of the year because of that, because people wanting to avoid taxes, and just because the market has been hungry for some activity for a while. Like since January, we have been going up. We have the Bitcoin ETF, but it's not like other bull markets. This one was more gradual. It was kind of like watching the Lakers play.
It didn't feel like a bull market.
It's like watching the Lakers play with LeBron, and he's only hitting open shots. No dunks, no crazy passes. Just good looks, hitting open shots, and that's it. So
I was just thinking about how excited the crowd would be once he hits that third open shot. Anyway, I actually agree though. I don't think it's worth sitting on the sideline like, oh my God, are we in a recession? Oh my God! Like if you have a position and you haven't sold, it's good. Hold on to that thing. Probably buy more. Let's take Intel for example. On Friday, their stock dropped like 25%, right? And they announced that they're probably going to cut up to 15,000 jobs, which is insane. That's insane. I didn't even know that many people worked for Intel. I got to be honest. But anyway, cutting 15
Intel.
I know, but 15,000 jobs is insane. That means their workforce is huge. They got I don't know how many people they have. 100,000 people they got working for them, which is just insane, bro. But anyway, cutting 30% of the workforce, 15,000 up to 15,000 individuals. Now, a lot of people will look at that and say, "Ooh, they're done. I'm finished. Finito. No buying for me, my friend." Anyway, and others who understand opportunity, they will look at that and say, "Okay, well, there's probably an opportunity. Someone comes in, structures some type of deal which removes the liability that Intel has currently on their balance sheet, which would make their stock go through the roof again. And now they're completely recovered. And those investors who bought the dip on that 25% drop, just gained 30, 40% over the span of a month because they were able to understand the fundamentals of said company, which in this case is Intel. And so I do think it's important to just kind of keep those hands ready, keep the tendies ready. But also, I wouldn't be surprised if we saw a 1,500 ETH at this point. We're at like 2,300. I wouldn't be surprised if it got down to 1,500. And I also wouldn't be surprised, like he said, if Bitcoin dropped down to 40K, kind of part and parcel. And plus, we're still like only a few days into this correction. So we don't know if like this is the recession starting or if it's just like a temporary correction before the actual downturn. We shall see. So he said we're gonna see fireworks towards the end of the year after the election, right? You said that?
Or around. Depends.
Or around.
A lot of it depends on who gets in that thing.
Yeah, so we'll just say, he's expecting fireworks around the recession. I don't know. I would hope so. But if I'm just looking, I would probably say we're gonna be in bearish territory for the remainder of the year. That's how I'll look at it. And going into January, February,
no matter who wins?
No matter who wins, yeah. And when you get to January, February, you naturally have like this psychological effect on people when they get excited about the new year type deal. And I feel like this year for New Year, I feel like it's just going to be crazy. I don't know why. The 4th of July this year was insane. So I feel like New Year is going to be insane as well. I don't know why, but I feel like people are like, they're enjoying these celebrations a lot more over the past couple of years. I don't know why, but I feel like New Year is going to be crazy. And I can see, things moving back to the upside and all across the board, honestly, like starting in January, February. But I do think we're going to be bearish, most consolatory. Is that a word, consolatory? Basically, a period of consolidation going into the end of the year. And that's no matter who wins the election.
Bro, if Trump wins, you don't think crypto's going to go crazy, what he's been saying?
I don't think it's going to go crazy immediately, no. Because it doesn't really... The strategic Bitcoin reverse was SBR. Let's call it the SBR. So the SBR that Donald Trump has effectively promised at this point, that's just taking all the Bitcoin that they currently own. So they're not going to be buying new Bitcoin. They're not going to be, it's none of that. So it's nothing that's going to directly affect the price. If the price is affected, that's because of the psychological impact that Trump has when he says we're going to have an SBR. Even if we did see a pump, because there's no real fundamentals backing that price move, I think it'd just be a sell-off right back down to previous levels. Just been real, like very, very, very quick. So
I think the fundamental weight behind it would be, I feel like Trump is going to get regulation, like he's going to handle that shit before he's out of office. And I feel like
I agree with that.
I feel like people know that. I feel like institutions are going to be like, okay, we can buy because we know this guy's going to get shit done. So I agree in that it won't be anything fundamentally immediately, but I do believe there will be like a psychological foundation. You can call it a narrative too.
Yeah.
But I think by the time Trump gets out, if he wins, I think crypto would be in a really good place.
Yeah, no, I agree. And it may, I just think that will start to come to fruition in price for real towards January. Or in January, or maybe towards the end of December,
He might throw in some other tax thing again to where people save on taxes. That could be something too. We'll see.
Maybe. But that, I feel like he would have already mentioned it. Like, I feel like that was his card right there. Trump, especially him speaking at the Bitcoin conference, which he didn't really talk about the SBR. He mentioned it again, but he didn't go into detail on anything. And so I think that's like his card to like win the masses over, is having that Bitcoin reserve. And with stocks, who knows? Like I said, I don't know if this is a correction right now. I don't know if it's just a blip because of the margin calls. I don't know if investors are losing confidence across the board because of the uncertain time that we're in. And a lot of people are thinking cash is the safest investment at the moment. I'm not sure where we are. I got to wait a week or two, and then I'll have a better idea on, which direction we're getting ready to stay in. And yeah, with this whole Japanese yen thing, though, I just think that's a bigger issue for U.S. equities than people think. I feel like now that the floor has been kind of pulled from that, it's going to continue to exacerbate itself. It's like a self-reinforcing loop, because now a lot of foreign investors, they're leaving because, they're losing a ton of money right now.
They are the second biggest holder of our debt too, right?
Japan?
Yeah. That says a lot.
But also they're like the contradiction to global monetary policy. Like when everyone was raising rates, they were leaving them the same or cutting them. And now that everyone's cutting them, they can't raise them because their debt to GDP is over 200%, and that would like destroy their economy. So they can't really raise rates, and so they have to leave them where they are, while everyone else is lowering rates. So it's like, I don't know if all of the margin calls are at play yet, right? Because what happens is the money flows back into the yen, which is why we've seen it pop. I don't know if we're towards the end of that pop or we got more room to go in that pop. So we shall see. Like I said, I'm gonna wait like another week or so, get some more data in on that, and then kind of figure that out from there. But yeah, I wouldn't be too confident. That's just me though, and obviously I've been wrong before, only once before in my whole life. Not just playing, but yeah, I don't know what it's gonna look like towards the end of the year. But I wouldn't be too confident in that we're gonna see strong price action and risk assets, period, at all. And another thing, it's so funny because housing isn't a huge topic of conversation at the moment. And I don't see it going crazy in one way or the other. I see housing kind of staying right where it is on a national level, not talking about idiosyncratic markets like Miami, Florida, or, Phoenix, Arizona. Well, guys, we say all that to say, let us know what you think in the comments. If you find this content valuable, of course, guys, hey, don't forget to subscribe, of course. Okay? If you haven't, just go ahead and do it right now, especially if you're still here watching. Just hit that button.
Right Go ahead.
Right there. There you go. Listen to them. Now, make sure you like the video as well because that helps us with the algorithm. Make sure you leave a comment because we love the engagement and we just love to know what you guys think. So we're just not talking to a brick wall all the time. Make sure you follow Crypto Noah on his personal YouTube channel. Make sure you follow my personal YouTube channel at JManchin. And guys, of course, as always, we'll see you on the next one.